Welcome to Trader DNA. Today we're dropping a strategy you absolutely do not want to miss. If you're new to trading but hungry to learn fast, is your moment. We're talking about a simple 3-part game plan that helps you spot high probability entries, keep tiny stop losses, and aim for big asymmetric profits. No fluff, no confusion, just a clear system you can follow step by step. If you stick with me to the end, you'll have a complete beginner-friendly framework you can practice, backtest, and make your own. Ready? Let's kick this off by unlocking the backbone of the system, the exponential moving average, and I'll show you exactly how it guides every decision that comes next. Alright guys, listen up, because this is where trading gets super exciting. The very first step in this strategy is using the exponential moving average, or EMA, and trust me, you need this to lock in the bigger trend so you're not fighting against the market. Because here's the deal, if you go against the main trend, you're basically swimming upstream. You'll waste energy, take unnecessary risks, and most of the time, you'll lose. But when you follow the bigger trend, that's when you ride the wave, catch massive moves, and do it with a much smaller stop loss. That's how traders win big over the long run. So let's break it down in the simplest way possible. The EMA is one of the most popular tools traders use to figure out the overall direction of the market. And here's how it works. It's just a line on your chart that reacts faster to price than a regular moving average. Now, if the price is moving above that EMA line, boom, that's a bullish trend. The market's pushing upward, buyers are in control, and your best chances for profit are going long. If the price is below the EMA line, that's a bearish trend. Sellers are dominating, the market's falling, and short trades make way more sense. But here's the tricky part. Sometimes the price moves sideways, just bouncing around the EMA line. When that happens, it means the market is in a sideways or choppy conditions, and that's usually your signal to stay patient. But here's the million-dollar question. How do we know the perfect EMA setting to use? Because if you pick the wrong one, the line becomes useless. It won't tell you anything. The secret is simple but powerful. You've got to watch how price reacts to the EMA. Does it bounce cleanly? Does it act like a wall the price keeps rejecting? If yes, that EMA setting is working. If not, adjust it until you find the one that the market clearly respects. And guess what? I already showed you step by step how to do this in a full breakdown video I uploaded a few weeks ago. If you missed it, you need to check it out after this one, because that's where I showed exactly how to test and find the right EMA period for any market and any time frame. Once you lock in the right EMA, everything else in your strategy becomes 10x more powerful. Alright, listen up, because this part is insane. I'm about to reveal one of the biggest secrets in trading that almost nobody talks about, choosing the perfect EMA period. Yeah, you heard that right. Get this one setting wrong and your whole strategy can collapse like a house of cards, but get it right? Oh man, it's a complete game changer. So what even is EMA? Exponential moving average. Sounds complicated, right? But forget the fancy name, it's just a line that shows you which way the market's moving. Simple. But here's the crazy part, the power isn't in the line itself, it's in picking the perfect period for that line. That's the cheat code most traders miss. Here's how you find it. Don't guess. Test. You literally watch how price reacts to your EMA. If it hugs the line like a magnet, if it bounces off it like it just smacked into an invisible wall, boom, that's your golden setup. That's when you know the EMA is dialed in. And check this. This isn't some one and done magic number. Nope. You start with the 20 EMA, then 34, then 50, 75, 100, 150, all the way up to the 200. One by one, test them. Watch how price reacts. Is it rejecting clean? Is it respecting the line? If yes, you've struck gold. In our test, the 100 EMA was king. Price bounced off it like crazy. So guess what? That's the EMA we lock in for this chart in this time frame. But hold up, don't just blindly copy that number everywhere. That's the rookie mistake. Different markets, different time frames, different EMAs. You gotta repeat the process each time. That's why there's no universal EMA period. It's about adapting. Here's the bottom line. If you skip this, you're gambling straight up. But if you do it, you're analyzing like a pro. You're stacking the odds, you're locking in cleaner entries, and you're building a strategy that actually works. This step right here, it's one of the most ignored but most crucial secrets to trading like a beast. And now you know it. So remember, step 1, EMA is your compass, your North Star in trading. Get this right and you're no longer guessing. You're trading with the market, not against it. And that's how you set yourself up for way more wins and way fewer losses. All right, guys, let's jump straight into the chart. Look closely, like really zoom in with your eyes, and you'll notice something super powerful. The price doesn't just move randomly. Over and over again, it keeps reacting to the same pattern. Sometimes it tries to smash through the EMA line, but if it can't break it, boom, it bounces back like it just hit a trampoline. Other times it actually breaks through, but when it fails, that rejection is like a flashing neon sign telling you where the trend is. Now you might be wondering, where did this amazing EMA line even come from? Did I just guess it? Nope. The answer is simple. It came from the exact process I showed you earlier, step by step. And in this chart, the golden winner is the 200 period EMA. But listen carefully. 200 is not some magical number that works everywhere. It just happens to be the one that the market respects the most on this chart, in this time frame. But here's the exciting part. You can find your own magic number depending on what chart you're looking at and what time frame you're trading. Maybe on another chart, the market respects the 150 EMA or the 100, or maybe even 250 or 300. That's why testing and watching price reactions is so important. And here's something you cannot forget. Since this step is all about finding the long-term trend, you need to use big numbers for your EMA. Forget the tiny ones. Don't go with 5, 10 or 20 periods for this step. They're way too small and won't show you the bigger picture. Stick with heavy hitters like 100, 150, 200, 250 or even 300. These are the ones that reveal the real trend that the market respects. So remember, your job here isn't to copy my number. It's to figure out which EMA period your chart listens to. Once you find it, you'll be locking in the bigger trend like a pro. And when you trade with that trend, your chances of winning skyrocket while your risks shrink. That's how you play the game the smart way. Now let's move to the second step. And this one is a total game changer. We're talking about key support and resistance zones. Think of these zones like the VIP areas of the market. The price doesn't care about every single level. It only reacts strongly at these special zones. And when you learn how to spot them, it's like having the cheat codes for trading. So what's the big deal? Why do we even care about key support and resistance? Because they give us confluence. Basically extra confirmation that our entry is not just good, but insanely strong. This is what takes an entry from maybe to high probability, and in some cases, it feels almost impossible to lose. Imagine stacking multiple layers of proof before taking a trade. Support and resistance are the layers that lock everything together. Here's why I'm teaching you this. I don't just want you to enter the market randomly. I want you to enter with confidence, the kind of confidence where you know the odds are massively in your favor, and that's only possible when your entry comes from a high quality signal. But here's the catch. These signals don't show up every minute. You can't force them. You only take the trade when step 1, trend with EMA, and step 2, key support resistance line up perfectly. If they don't, you wait. No exceptions. Check out this chart as an example. Right here, we've got a key support zone. Notice how price reacts to this level over and over again. On one side, it acts as resistance, and on the other side, it flips into support. So when price comes back into this zone, that's your cue. If you see a buy signal forming at this exact spot, that's your chance to strike with a high probability buy entry. But wait, it gets even better. Why is this zone so special? Because it's not just any random level, it's a key support zone sitting above the 200 period EMA. That means we've got two powerful signals stacked on top of each other. The trend confirmation from the EMA and the bounce from support. When you combine those, it's like having the Avengers on your side. Your setup becomes almost unstoppable. That's why pro traders always pay attention to these zones. They don't ignore them, and neither should you. I really want you to get this, because once it clicks, everything about your trading will feel different. You'll stop guessing and start waiting for the exact conditions that give you the edge. And to make it even clearer, I'll show you an example in a bearish trend, because once you see it in action on both sides of the market, it'll blow your mind how powerful this really is. All right, look closely at this chart. Right here, you can see a key resistance zone, and not just one random spot. We're talking about multiple areas. This one, this one, this one, and this one. These zones are basically the danger zones where price struggles to break higher. Every time price touches them, it's like the market is saying, nope, not today. And that's exactly why traders lock in on these levels. Now, here's the important part. When price climbs back up to these key resistance zones, you don't just sit back and do nothing. You get ready, locked in, focused, because if a sell signal pops up here, that's your chance to strike. It's like the market is handing you a golden ticket, but only if you're paying attention. So why are these zones so special? Why do pro traders obsess over them? Here's the answer. These resistance zones are sitting below the 200 period EMA, and when that happens, boom, you've got two powerful confirmations stacked together. 1, the EMA is screaming the trend is bearish. 2, the resistance zone is showing where sellers are waiting. That's double strength. That's the kind of setup you absolutely cannot afford to ignore. And here's what it really means. You're not the only one watching this level. There are thousands of traders all over the world waiting for the exact same thing, price hitting this zone and a sell signal showing up. It's like a giant crowd lining up at the same starting line, all ready to push the market in the same direction. And when that happens, the move can be explosive. Price can drop hard, fast, and far because the 200 EMA is pushing down and sellers are piling in at resistance. This is why you never rush trades and you never guess. You wait. You sit on your hands until the stars align. When step 1, the EMA, confirms the overall trend, and step 2, the key support and resistance, marks out the exact battle zones, that's when you strike. That's when you trade with accuracy, confidence, and power. If you can master just these 2 steps, you're already ahead of most beginners. These are the foundations of every high probability entry. This is how you stop losing randomly and start trading like someone who knows exactly what they're doing. This is how you build confidence, how you stack wins, and how you become profitable long term. And now that you've got step 1 and step 2 locked in, here comes the really exciting part. In the next step, I'm going to show you how to use the CCI indicator as your high accuracy entry trigger. This is the tool that will take all the groundwork we've built and turn it into precise entries that almost feel like the market was designed for you to win. Step 3 is where things go absolutely insane, because now we're bringing in the Commodity Channel Index, or CCI. And listen, I know the name sounds scary and complicated, but don't freak out. It's actually super simple once you see it in action. And by the end of this, you're going to feel like you've unlocked a secret cheat code for trading. So check this out. Imagine your chart has this bright orange line that's always bouncing up and down like it's on a trampoline. That's the CCI. And right in the middle, there's this line called 0. Think of it like home base. Every time that orange line shoots way above 0 or way below 0, it's not just random. It's the market literally shouting a message at you about what might happen next. Now here's where it gets crazy. The CCI has 2 special danger zones like glowing red warning lights, plus 100 at the top and minus 100 at the bottom. When the orange line blasts above plus 100, boom, that means the market is overheated, buyers are going crazy, and there's a huge chance price could reverse. Traders call this overbought. But if the line crashes below 100, that's the opposite. Sellers have pushed way too far, the market's exhausted, and price could slingshot back up. That's called oversold. But here's the best part. This isn't just some random squiggly line copying what other indicators do. While RSI also bounces up and down, the CCI is built different. It digs way deeper into market momentum and strength, giving you signals that are sharper, faster, and honestly, just way more useful when you're hunting for big turning points. Now let's picture this in real life. Price is moving under the 200 EMA. You already know the trend is down. You've marked your resistance zone, and then bam, the CCI rockets above plus 100. But wait, it doesn't stop there. When the CCI drops back under that plus 100 line, that's your high probability sell signal. It's like a giant red flag waving in your face, screaming, get ready, sellers are stepping in right now. Flip it the other way. Let's say price is bullish and you've spotted support. Suddenly the CCI dives under -100. Then, boom, it bounces back up above that 100 line. That's your buy signal. It's like the market whispering, the bounce is coming. Don't miss it. And this is why pro traders love the CCI. It's not just noise, it's a precision trigger. It shows you exactly when the market has stretched too far and when it's snapping back. And when you stack it with step 1, the EMA trend, and step 2, support and resistance, the CCI becomes your sniper scope, the final confirmation that tells you exactly when to pull the trigger on your trade. And here's the real kicker. Once you master this, you're no longer guessing, no longer stressing, no longer confused by the charts. Instead, you're trading with a system that stacks the odds in your favor. That's the difference between a beginner who feels lost and a trader who feels confident, sharp, and ready to crush the market. Alright guys, let me break this down with another example so you get crazy clear on how this strategy actually works, because once you see it, it's going to click big time. Step 1, the exponential moving average, or EMA. Look at the chart. Boom, the price is sitting above the 200 period EMA. That's our first green light. Why? Because when price is above that line, the market trend is bullish. And that instantly tells us one thing. We only focus on buy entries. No selling, no guessing, just buy setups. Simple and powerful. Now step 2, finding the key support and resistance zones, the levels that actually matter. And listen carefully, this is huge. A key support zone must be crystal clear on the chart. You can't force it, you can't fake it, because if you made it up, other traders around the world won't see it. And if they don't see it, it's worthless. The market only respects real zones that everyone can agree on. Right here, this is our key support zone. Rule number 2, completed. Step 3, now we wait for the perfect setup. Price needs to pull back, sliding down toward the 200 EMA, but not breaking through it. At the same time we're watching the CCI indicator, it must dip below the -100 level. And here's the catch. The dip in CCI must line up with price hitting the key support zone. That's the magic combo. And then boom, it all flips. Price bounces upward, the CCI rockets back above -100, and the market explodes off that support zone. That's our perfect buy signal. Low risk, massive reward potential. The exact kind of trade we dream about. So the move? Enter a buy on the very next candle, lock your stop loss just under the nearest swing low, and watch as the market blasts off in your favor. This is what a high probability setup looks like. It's clean, it's powerful, and it stacks the odds massively in your favor. And don't worry, because I'm not stopping here. I'm about to show you the flip side. The high probability sell setup you absolutely need to master. And once you get both of these down, you'll be on your way to maximum trading success. Alright, now let's flip the script and look at the sell entry signal, because this is where things get seriously exciting. Step 1, exponential moving average, or EMA. Check out this chart. The price is clearly sitting below the 200 period EMA. That's our first confirmation locked in. And what does it mean? Simple. The market trend here is bearish, and when the trend is bearish, we only focus on sell trades. Forget buy setups, they're off the table. The only direction that matters right now is down. Step 2, we need to find the key resistance zone, the zone that actually has power in the market. And listen, this is crucial. A resistance zone must be obvious, crystal clear, and undeniable on the chart. You cannot invent it. You cannot force it. If it's fake, other traders won't see it, and if they don't see it, it's worthless. The market only reacts to zones that are visible to everyone. Right here, this is our key resistance zone. It's clean, it's sharp, and it checks off rule number 2. Step 3, patience. We wait for the setup to develop. Price needs to climb back up toward the 200 EMA, but it cannot break above it. While this happens, we're watching the CCI indicator. It must push up through the +100 level. But here's the catch. It has to do that exactly when price is touching the key resistance zone. That's the alignment we're waiting for. And then boom, the reversal hit. Price slams down, the CCI drops back below plus 100 and the market bounces off resistance like it just hit a brick wall. That is our sell signal, and it doesn't get any cleaner than this. The risk? Tiny, because your stop loss goes just above the nearest swing high. The reward? Huge, because when signals line up this perfectly, the price almost always breaks hard in your favour. This is what we call a high probability setup, and it is pure gold. And the best part, this strategy isn't complicated. It's powerful, it's straightforward, and even beginner traders can understand it and use it to grow fast. High probability sell signals like this are the kind of opportunities that separate casual traders from consistent winners. This strategy is insanely accurate and totally reliable, but only if you follow the rules we talked about earlier. And here's the deal. If the rules aren't met, you do not enter the market. Seriously, forcing a trade without the rules is emotional trading, and that's exactly how beginners blow up their accounts. The best part? This strategy is ridiculously simple. You don't need to be some math genius or spend hours setting it up. I've made it super easy for you. I built a ready-to-use template you can download right from the description. Drop it on your chart and boom, everything's set up instantly. No stress, no confusion, no wasted time. This is plug-and-play trading at its finest. And hey, if this video helped you learn something new or made trading feel way easier, do me a favour, smash that subscribe button, turn on notifications so you never miss the next strategy, and share this with your friends on WhatsApp, Facebook, or X. That way, you're not just levelling up, you're helping others level up too. Thanks for watching, and I'll see you in the next one.